Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from social medias. I would like to welcome back Rick Rule to my show. Rick is always a great guest to have, and my pleasure is to have you again. Rick, welcome.
Lucian, thank you for having me on the show, and thank you for your participation in our annual conference in Boca Raton. It was a delight to see you in person.
It was a great conference. It was a brilliant organization, and I urge investors to come next year. As I heard, it's going to be much better even. But we will leave you to disclose the details when the time comes. Rick, I would like to start with your views of U.S. central bank lowering interest rates for the first time in more than 4 years, with a bigger than usual cut, actually. My question is, how will this affect the markets, and do you see more cuts in the remainder of 2024?
Well, they jawboned this cut so much ahead of time that I think a lot of the impact of the rate cut was already factored in the market. Anybody who listened, they told you that they were going to cut rates. Consensus was 25, we got 50. So there was some follow through in equity markets, and of course, nice follow through in the gold market. Although the response was mooted because everybody knew for 3 months before what was going to happen. It's interesting to me, Lucian, that our government tells us that our economy is in such good shape. If it is in such good shape, why do we need a 50-point rate cut? So I think they said at least 3 things. The first thing is that the rate is political, not economic. They haven't admitted it, but their actions show it. The second thing is that they are as much concerned about the state of capital markets, which is to say debt and equity markets, as they are the state of the broad economy. And the third thing is that the broad economy is not in as good shape as they would have you believe. The broad economy is in great shape for an old, fat, bald, rich guy like me. Subsidized interest rates, very low interest rates, benefit people with access to credit and people with the education to use it. That is to say, guys like me. Is the government trying to subsidize guys like me? No. The truth is that the economy isn't working well for people in the bottom half of the demographic. Yes, there's a lot of jobs, and most people have to have 3 of them to make a living. For those people who vote, and they're going to be voting very quickly, the economy is not working well, and appealing to them, even by way of lies, is something that politicians have to do. What investors have to understand, separate and apart from the moral aspects of a rate cut, is that more cash in the economy simultaneously increases the near-term rewards and enhances the long-term risks. What the Fed has decided is that inflation is less important than politics. And as you make credit more freely available to people like me, you stimulate animal spirits at the same time that you increase, A, the depreciation in the purchasing power of the US dollar, and B, the real return to savers after inflation. So investors need to take both of these circumstances into account. Investors, I think, Lucian, also need to take into account that while increases in liquidity and a decrease in the discount rate increases confidence and lowers the near-term probability of a liquidity squeeze or a market panic, it increases the impact of that in the longer term. So investors need to take into account the fact that this near-term party might carry with it a longer-term hangover. I'm not suggesting that you organize your whole life around panic and fear. I'm just suggesting that your listeners maintain enough liquidity that if the party ends, and some of that liquidity should be in gold, that they benefit from the circumstance, as opposed to being victimized by the circumstance.
Well said. Besides that, you are old and fat, I would disagree on that. But despite your age and with your energy of 18-year-old boy, you are very active on social media as attending and organized conferences, just like we discussed. And you are in everyday communication with the CEOs and the market experts. I believe my listeners would like to hear how is the sentiment among them when it comes to potential market correction event or possibility of even big crash. Do you see that they are more cautious than before?
You know, Lucian, it's hilarious that you asked me that. When I was actively employed at Sprott, running their brokerage operations, I made it a point every quarter to call 25 or 30 business owners, both public and private. And I would say, how do you feel about the broad economy? Terrible. How do you feel about the direction of the US economy? Terrible. What's the outlook for your own business for the next 12 months? Wonderful. And I would say to them, you realize I'm having this conversation with 25 or 30 guys. And the answer is always the same. The world's going to hell in a handbasket, but my country's doing great. My company's doing great. And of course, collectively, you guys are the country. So you need to leaven some of this nervousness with the understanding that both the upsides and the downsides are concentrated. It would seem that among the audiences that you and I serve, Lucian, they're really responsive to Agora direct mail, which is to say, the world's going to end on Thursday, and here's how you can profit. Now, in direct answer to your question around talking to public company, resource company CEOs, the response really depends on the nature of the companies. For the very small companies, the exploration companies, which are out of favor, new cash is very difficult to come by.
Yeah.
Conversely, if they're prospect generators, if they're people who are generating exploration ideas and selling them to major mining companies, the demand for high quality exploration targets has never, ever, ever been better. People like Elemental Altus, EMX Royalty, Kennerland, Riverside, Mondoro, the prospect generators are seeing large intermediates and major mining companies cleaning them out of exploration projects. So what that means is that we are gearing up for exploration on the quality side to shift into high gear. And that will be reflected in the market. This year, maybe not. Next year, almost certainly. Among the larger companies, you'll recall that at our conference, we had Sean Boyd, former CEO and now chairman of Agnico Eagle. I had the ability to have him for lunch, separate and apart from all the attendees, where I could actually talk to him. We've known each other for 30 years. And he just basically looked me in the eye and said, Agnico Eagle is in the absolute flush years. We have a wonderful team of people who've been together for 20 years. We have solved all of our major operational problems. The gold price is going up so that our margins will increase faster than our costs. We have a wonderful pipeline because we invested for 10 years when nobody else did. And this sort of bullishness among the best companies, not just the biggest, but the best companies, is ubiquitous. When the industry talks about a dearth of financing available for the small companies, what they're talking about is 80% of the small companies. I note that this dearth of financing isn't something I've experienced. For probably 80% of the financings that I've wanted to get invested in for the last 2 years, they've been oversubscribed. Yeah. So the market is doing a rational thing. It's beginning to discriminate in movie parlance between the good, the bad, and the truly ugly, which is helpful. I think that corrects itself. I think we're going to go into a full-fledged precious metals bull market, and after that, a full-fledged natural resources bull market, at which point in time, the investors will be just as stupid as they were 15 years ago. But for now, capital allocation is taking place, and that's the sign of a very healthy market.
Yeah, I agreed on the commodity bull market super cycle. I definitely agree on that. But let's say potential market crash really happens, the scenario really happens, and the recovery after that. What do you think, Rick, which commodities would recover first? Or actually, do you see some commodities decouple and not crash with the general markets?
No, what you find is if the crash that you're talking about takes the form of the 2008 crash, which is really a collapse in confidence and the removal of liquidity from the market, everything goes down.
Yeah.
Because the sell decision isn't made by Lucien. It's made by Lucien's margin clerk. And he or she doesn't care what you think about an asset class. They're just looking for a bid. So if you'll recall 2008, the gold market held up for 24 hours and then it fell apart too. They take no prisoners in that kind of war. What happens is that the most stable asset classes recover first. And if you look at the recovery of various financial markets in 2008, one of the first to recover was the gold market. Why? First of all, people go to gold in times of fear. It is an asset that isn't simultaneously somebody else's liability. You don't need to make a credit decision if you own gold. The second is that it was very obvious in the aftermath of the 2008 crash that the policy response would be to add counterfeit liquidity, which is to say to print, which obviously inures to the benefit of gold. The other asset classes that did well were very high quality short-term bonds, secure places to put cash to ride out the storm. The third asset class that did well was the largest industrial corporations in America, the most liquid markets with the best balance sheets and the best profit margins. In other words, there was a distinct flight to quality. What didn't recover for a very long time were tertiary assets, marginal assets. Sadly, there's no more marginal asset on the planet than a penny mining share. So if we have a real market crash, the asset class that your listeners are holding for maximum upside will deliver them, at least in the interim, maximum downside. And people need to understand that, which is why I ask people to have most of their portfolio in natural resources around beta, most of their portfolios around natural resources in the highest quality companies, with the most trading liquidity, with the best balance sheets, with current operating margins, and with their soundness and stability demonstrated by an earned dividend yield. I'm not saying to people, don't do what I did. I'm not saying to people, don't chase the 10 baggers, the 20 baggers, and the 30 baggers. Chase them with money that you can afford to lose. Chase them in circumstances where you are certain enough about the long-term future of the company that you can psychologically and financially weather a 50 or 60% share price decline should a bad market come.
Yeah, you told me at the beginning of the interview about the importance of having cash on the side. Do you believe that now is a good time to increase cash position and decrease equities exposure?
I think that depends on how much work you're willing to put into things and how opportunity constrained you are. I'm trying to allocate cash right now. I have too much cash. A wonderful problem, by the way.
Yeah.
If I were a normal human being, I would probably buy more gold, but I've been buying gold since the year 2000, actually since 1998. And I have a gold-centric portfolio. I don't need to buy more gold. What I am trying to do is increase my risk-on positions. The difficulty with that is that the private placement opportunities that I'm seeing aren't sufficiently attractive to induce me to part with my money. Specifically, I'm not getting very many warrants. And I love warrants. If you want me to speculate, you have to make it worth my while to take the risk. I'm also actively engaged in trying to increase my position in convertible preferreds. In circumstances where I give up some of my upside in return for eliminating most of my downside. The one area where I have been able to deploy capital, and this isn't available for most investors, is I have been able to buy privately tranches in the senior secured revolving credit facilities around major oil and gas and natural resource companies. Think of these as very high quality 366-day bonds. And I have been increasing my position in that because they've been available to me very, very aggressively. But I still have, by traditional standards, too much cash. For most people, the arithmetic involving cash is as follows. on a current basis, you are losing money. If, as an example, in the US dollar, you're in the benchmark savings instrument in the world, which is the US 10-year Treasury, the US government is paying you 4%. If you believe that the degradation of your purchasing power is accounted for by the CPI at 2.6%, you're making a 1.4% real yield, which in a historic sense isn't bad. If you believe, like I do, that the real deterioration of the purchasing power of the US dollar is about 7.5% compounded, it means that holding cash is costing you 3.5% of your purchasing power every year, which is not good. I stomach that because I have lived through several market panics in my life. And during those market panics, if I had liquidity when nobody else had it, I had both the tool and sometimes the courage to deploy that capital when nobody else was deploying theirs. In other words, I was able to take advantage of a market decline rather than being taken advantage of. And I regard the negative real yield on my savings to be an option premium on having the ability, having the access to that capital when other people have neither the capital nor the courage to use it. And I think that's an important consideration for every single listener that you have.
Yeah, when you mention deploying capital, so in which commodity have you wrote the most checks in the last 12 months?
Probably in the private oil and gas sector. I am really, really, really attracted to North American natural gas. The market hates it. The market clearing price for Canadian natural gas, which is more depressed than US natural gas, is about $1.50 US per million BTU at the Alberta gate. That same gas landed in Rotterdam or Shanghai or Tokyo sells for $8 a million BTU. And it takes about $1.50 to get it from where it is to where it's needed, which is to say a 70% gross margin. That's an insanity. And there are billions of dollars being spent every month to arbitrage that away. Construction of gas storage and transmission facilities, construction of liquefaction facilities, construction of gas supertankers, the onshoring of the of the European fertilizer and petrochemical industries from, say, Germany or Belgium to the United States Gulf Coast. This is happening right now. And this arbitrage will be gapped. Right now, there's no capital available for North American natural gas. The idea that I can compete in a sector where I think that the capitalized value of capital assets will increase threefold over 5 years with nice current yields and no competition is stupidly advantageous to me. I have increased a little bit for myself, but a lot for 4 family offices that I advise, shareholdings in the best of the best senior gold companies. I have noticed that when you go into a real gold bull market, that the index itself can increase by 300%. The idea that I could buy the very best companies in the sector and perhaps only enjoy 250 as opposed to 300%, while eliminating the downside risk associated with financial insolvency and operation, that's a really good print for me. I believe in my heart of hearts, no guarantee because I believe it, by the way, Lucian, but I believe that we're coming into a real gold bull market. And it wouldn't surprise me at all if a portfolio comprised only of the very, very, very best gold stocks appreciated by 300 or even 400% over the next 5 or 6 years. The idea that I think I have a probability rather than a possibility, not a certainty, of a 300% gain over 5 or 6 years with virtually no operational risk is extremely attractive to me. That doesn't mean that I don't take some capital of my own, work very hard with it, take big risks in smaller companies, and shoot for 10-fold gains or 12-fold gains. I do that. But my preference is not my preference. I think for most people who are less invested in precious metals than I, that they start at the very top of the pyramid.
Rick, okay, do you think that the current gold price reflects in the right way the condition of the world we are living in? Or would you say that gold is still undervalued? I mean now, I mean today.
I am afraid, honestly afraid, that gold will go much higher. I don't own gold because I think it'll go from 2,500 to 3,000.
Exactly.
I own gold because I'm afraid it'll go to 9 or 10,000. Is this a prediction? No, it's a fear. But let me give you the math, not the narrative behind the fear. The US economy, and I'm a US citizen, so of course I'm US centric. The US economy is 23% of the world savings and investment market. While the US is becoming less prominent, it's still hegemonistic. And the arithmetic around the US economy is scary. At the federal level, our on-balance sheet liabilities exceed $35 trillion. But much more scary than that is the net present value of our off-balance sheet liabilities. Unfunded Social Security, Medicare, Medicaid, government worker pensions, military pensions. That number, not the aggregate number, not the number over time, but the net present value of unfunded liabilities exceeds $100 trillion. So the aggregate liability of the US citizenry expressed by the federal government is $135 trillion negative. And that number is increasing by $2.5 trillion a year in the on-balance sheet liabilities, and recent estimates suggest $5 trillion a year in the off-balance sheet liabilities. Now, the aggregate revenues, the total revenues of the federal government are $4.6 trillion a year, which is to say that the deficit that we're incurring on an annual basis exceeds our revenues by more than 2 to 1. How do we get out of this circumstance? There's only 2 ways that I can think of. You change the nature of your payments, which is to say you means test Social Security, you reduce the benefit, you change the year that people accrue it, which will wreak real hardship in the US economy. And likely, you inflate away the net present value of the obligation. What the United States did in the decade of the 1970s is via inflation, they inflated away 85% of the net present value of their obligations. They devalued the US dollar in terms of purchasing power by 85% over 10 years. That coincided with an increase in the gold price from $35 an ounce, admittedly price controlled, to $850 an ounce. What I'm telling you in a very long-winded fashion is that if past is prologue, the US government will have to do again to the purchasing power of the dollar what they did in the decade of the 1970s. And it is likely to me that the financial asset that people will turn to as a consequence of the deterioration of their purchasing power in US dollar savings will be gold.
Yeah, right. Rick, what would you say if I ask you which commodity has the potential to double first? I mean, oil is at below or around 70, silver is around 30, 31. Would you say, for example, those two have higher probability than to double than the scenario of gold doubling to more than $5,000?
I think I'd have to think about that. I don't have an answer. I think in a speculative scenario,
Rick Roll doesn't have an answer. That is the first.
In a speculative scenario, if you're playing unbridled upside rather than probabilities, I think you probably look at silver.
Yeah.
Silver hasn't kept up with gold in commodity appreciation because the buyer in the market has been a fear buyer. It's primarily been central banks. If the precious metals narrative continues to the generalist investor, if past is prologue, when the generalist investor comes into the precious metals market, they come into the silver market. I'm not saying, by the way, that silver is going to run anytime soon. I think that gold will, for a while, continue to outpace silver. But if I were to speculate on which commodity has the best chance of doubling, that would be silver. If you give me 5 years, that's a different circumstance. That's North American natural gas. It's worth $8 on world markets. It sells in the US for $2.25 and in Canada for $1.50.
Yeah, and copper too, probably. Like you said, in 5 years time horizon, copper could go double, more than double.
The difference is that the copper market isn't as depressed as the natural gas market. Natural gas is being produced as a byproduct for oil as a consequence of fracking technology. And so there's an oversupply in the market. There's too much supply available, even though the demand is there, because we don't yet have the infrastructure to get the supply to the demand. But we'll fix that problem. It reminds me of the lithium market 5 years ago. We didn't have a shortage of lithium. We had a shortage of lithium processing capacity. And demand for lithium chemicals in battery applications, among others, increased faster than our ability to turn raw lithium into lithium products. So the price of lithium products went up fivefold. But over the last 5 years, we have developed the processing capacity. When supply met demand, the price fell by 75% after having gone up by 500%. Markets work. The same thing will happen in natural gas over the next 5 years.
Okay. Let's touch on uranium a bit. Do you see any new headwinds or tailwinds in uranium that could change the thesis of this sector?
The headwind that you have to be cognizant of is the possibility of a plant failure, of the repeat of a Chernobyl or a Fukushima or a 3 Mile Island. That's the only thing that I can think of that could defeat the uranium market. And you always have to have in the back of your mind the knowledge that a human failure at a plant could demolish the entire thesis overnight. Cheery thought, I know.
Yeah.
Absent that, what you need to know is that the current spot price for uranium is sufficient. It is the incentive price. The price of uranium doesn't have to go up. I think it will go up, but that's a different question. What's important to understand is the changing structure of the uranium market. The spot market is no longer the arbiter of the market because in uranium, unlike any other commodity, you have a contractual term market. And that means that both buyers and sellers can lock in a price only distally related to spot for periods of time as long as 10, 15, 20 years. And what that means is that both utilities and producers have some certainty as to the volume and the price for their product. What it means for producers is that unlike in any other commodity, they can understand their revenue line going forward with a greater degree of certainty that happens in any other commodity. It means that their cost of debt capital should be lower than any other commodity, and their cost of equity capital should be lower. This will manifest itself in the market over the next 5 years. It won't for the penny ante uranium juniors that don't have any uranium to contract for. But for the 10 or 12 developers who are looking for capital to build out their mines, for the Paladins of the world, the Lotuses of the world, the NextGens of the world, the Fissions of the world, this will lower the capital and lower barriers to access in capital in a way that we haven't seen in any other commodity at any other point in time in history. This is really, really, really important.
Yeah, we saw pullback in uranium equities. Are you a buyer at these levels?
If you assume that there's 90 uranium juniors in the world, which is what I think they are, I'm not a buyer of 80 of them. I'm a buyer of 10 of them. I'm a buyer of companies that can take advantage of the changing structure of the uranium market. That's where I am. Don't let your listeners use this as an excuse to buy the penny dreadfuls, the little uranium companies that don't really have any access to economic uranium. They're just looking for uranium, or enjoy, if that's the right phrase, substandard projects, projects that would require $100 uranium to work. Look for companies that could sustain themselves at $60 uranium and can establish long-term supply contracts with investment-grade counterparties, with Tokyo Electric Power, China General Nuclear, Duke Power, Southern companies. Those are the companies that are going to turn into absolutely free cash flow annuities in the next 15 years.
Okay, final question actually. What is Rick Rule buying right now?
Uh, on the debt side, senior revolving credit facilities for investment grade multinational mining and oil and gas companies. Boring. What I'm trying to buy is private placements with warrants or convertible preferreds in high quality juniors in capital short companies. Unfortunately, the terms I'm being offered are lousy. And while the companies are very good, there is still too much capital in the best end of the junior space. So I've been unable to participate in that market. I would be buying the best of the gold companies. I would be buying Wheaton Precious. I would be buying Franco-Nevada. I would be buying Agnico Eagle, but I own boatloads. I have no need to buy them. I took care of that 4 years ago. For most of your listeners whose portfolios are probably concentrated on the bottom end of the quality spectrum, I would suggest that you upgrade a portion of your portfolio. In a gold bull market, those companies will benefit first, and they'll benefit with less risk to you. And by the way, pay you an attractive current dividend while you wait.
Exactly, Rick. We left the best for the end. After a very successful Rule Symposium, we talked about you are organizing another one, but in a virtual format. This time it is Rick's Rule Tier 1 Asset Bootcamp, right? Tell me more about it, please.
Every 90 days, the Rule Classroom puts on an 8-hour-long video conference, a real deep dive into one subject. We've done uranium, we've done silver, we've done prospect generators, we've done royalty and streaming. In this boot camp, we're going to focus on tier 1 deposits. A tier 1 deposit, in my estimation, is a deposit with minimally $10 million in situ recoverable reserves and resources, preferably $20 billion, where the deposit is or will be, according to your calculation, in the best cost quartile worldwide in its sector, and in the highest return on capital employed worldwide in its sector, with a minimum return on capital employed of 25%. Multi-generational assets that are large enough that they can be financed and that they can come back from some mistake, from some operational failure. I've learned in my life, Lucian, that small mines make you small money but have big risks. Big mines also have big risks, but they can make you big money. Typically, I look for tier 1 deposits that are selling for less than half of the net present value of the deposit at current commodity prices. This usually occurs in commodities that are out of favor. And no surprise, the companies that we'll look at have nickel deposits or rare earth deposits or industrial materials deposits. But there's also 2 gold companies that we might look at. It's odd that a material in as much good favor as gold might offer up tier 1 deposits, selling at less than 50% of indicated net present value, with the potential for multi-decade production in the best quartile with regards to all-in sustaining capital costs and the best quartile with return on capital employed. it has been my experience that these tier one deposits over 5 years substantially outperform the market with less risk. We are not simply going to give you 5 names and walk away. We're going to teach you how to ascertain, how to understand tier one deposits. We're going to teach you the pitfalls of investing in them. We're going to familiarize you with political risk, because you always have to know why something is cheap. And that usually involves a jurisdiction that has real risk or perceived risk. And we're going to talk about that. We're going to talk for 8 hours. You will have access to the tapes for a year, and you'll need it, because we're going to give you more information in 8 hours than you can absorb. And these boot camps are not for tourists. If you are doing this for amusement, you're coming to the wrong place. Over 8 hours, you will not be amused. You'll be challenged. We're going to charge you for this too. This is not freeware. We're going to charge you $99 for this. But like with any other investor education product that I've offered up in the last 28 years, this comes with an absolute gold-plated money-back guarantee. If for any reason you don't think that in 8 hours we delivered 8 hours worth of knowledge for you, simply email me and I'll send you your money back. So the financial risk is all mine, although you'll never get that 8 hours back, and we're going to work you real hard.
Sounds really good. We will leave the link on the bootcamp in the description of this video. Mr. Rickrell, thank you for coming to my show.
Always a pleasure, sir. Thank you. And thank you again for your support of the Natural Resources Investment Symposium in Boca. One more thing, of course, if your listeners like my thinking with regards to natural resources, I'm happy to personalize it. All they have to do is go to my website, ruleinvestmentmedia.com. There, you can list your natural resource stocks on our drop-down menu, and I personally, for no fee and no obligation, will rank them 1 to 10, 1 being best, 10 being worst. Bear in mind that my rankings are very harsh. Don't prepare to be flattered. Understand, too, that I'm going away on vacation this Sunday, so you won't get a response for 2 weeks. Don't think it's because I've forgotten about you. Think about it, the fact that I've remembered my wife. Once again, ruleinvestmentmedia.com. List your natural resource stocks. Please no crypto. Please no pot stocks. Please no tech stocks.